All right, let's jump right into this. If you've been watching the pre-market tickers today, you've probably noticed something absolutely massive going on. We're looking at a spectacular 12% pre-market spike in Reddit stock. And it's all triggered by one major structural headline. Reddit is officially joining the S&P 500 index. Now, this isn't just your regular earnings pop, and it's certainly not some hype-driven meme rally. No, this is a foundational shift in exactly how Wall Street treats this company. So in this explainer, we're going to decode exactly what's driving this surge, figure out if the underlying business actually justifies the hype, and see what the charts are secretly telling us behind the scenes.
So here's our roadmap to figure out if this is a real game changer or just a trap. We'll start with the S&P 500 catalyst, look at the fundamental bull case, pivot to the technical bear case, and wrap it all up with a final verdict.
Okay, Section 1, the S&P 500 catalyst. Let's look at this structural shift.
So that massive 12% surge we're seeing, that is the market reacting in real time to S&P Dow Jones Indices announcing that Reddit will officially replace Avalon Bay Communities in the benchmark index. Joining the S&P 500 is essentially the ultimate stamp of validation for a public company. It literally takes a stock from being this optional, discretionary pick for portfolio managers to being an absolutely mandatory holding for thousands of funds.
And you have to appreciate the timeline here, because it is rapid. Think about it. Reddit just had its IPO in March of 2024. Fast forward to today's announcement, leading right up to the official inclusion on August 18th. That is a monumental milestone in record time. In fact, this rapid ascent makes Reddit only the second pure-play social media company in the entire S&P 500, sitting right alongside Meta. Huge achievement for a company that just went public.
Now here's where the mechanics come in. Because mechanical demand is the real engine behind this aggressive move. As JP Morgan points out, index funds tracking the S&P 500 will mathematically need to buy about 16.7 million shares of Reddit. And the crucial thing to understand here is that passive index funds, they don't care about technical resistance. They don't care if the stock looks a little expensive today, and they certainly don't wait around for a dip. If Reddit is in the index, they are mathematically required to buy it to balance their portfolios. To put that 16.7 million figure into perspective, that is nearly 3 times the stock's average daily trading volume just hoovered up by these funds.
Moving on to Section 2, Fundamentals, the bull case. Let's peek under the hood and look at the actual growth.
Before we get totally swept up in the momentum, let's look at their recent Q2 performance. Reddit didn't just beat expectations, they absolutely smashed them. They reported an actual earnings per share of $1.25, totally blowing past the 95-cent consensus. And this isn't some one-off fluke either. This marks their 8th straight quarter of sales growth topping 60%, with recent quarterly revenue hitting an impressive $805 million. The main driver? Advertising. That grew 64% year over year, thanks to better performance and some really clever new ad placements.
Which brings us to this absolutely staggering number, a 91% gross margin. I mean, wow. This is the absolute beauty of an asset-light platform powered almost entirely by user-generated content. They don't have to manufacture physical widgets or manage messy supply chains. When an advertiser buys space, almost every new dollar flows straight to the bottom line as gross profit. A 91% margin is elite territory, folks, and it gives them immense operational leverage as they continue to scale up.
And looking ahead, Wall Street analysts are forecasting this profitability to just explode. Take a look at the projected earnings per share jumping from $2.62 in fiscal year 2025 all the way to over $8 by fiscal year 2026. If they can maintain that high-margin ad growth, the fundamental trajectory of this business is basically a juggernaut. But hold on, let's do a quick reality check here, because it's not all sunshine. The CEO himself recently warned about choppy search referrals. Why? Well, Google's new AI overviews are actively disrupting how users find Reddit threads through organic search. On top of that, Reddit actually saw a recent quarter-over-quarter drop in daily active users in the US. So their heavy reliance on Google for new user traffic is a tangible, fundamental risk. And that risk doesn't magically disappear just because they join the S&P 500.
All right, Section 3, Technicals, the bear case. Let's slow things down and see what the charts are warning us about.
The stark reality for short-term traders is that Reddit stock has been absolutely hammered in 2024 prior to this news. Even if you factor in today's massive pop, the stock is still down about 31% year-to-date, and it sits a staggering 44% below its 52-week high.
We're looking at a legitimately bearish technical setup here. We've got a negative MACD, and back in mid-July, we saw a classic 3 black crows pattern. That's 3 consecutive days of heavy, aggressive selling, which historically signals a really strong continuation of a downtrend.
And the Relative Strength Index, or RSI, completely confirms this deep technical weakness. If you look across the board, on the daily, the weekly, and the monthly timeframes, the RSI is sitting squarely below that neutral 50 level. Because they are all flashing bearish, it means the overarching trend has been heavy selling pressure, regardless of today's sudden good news.
So what's the game plan? How do we actually trade this? You've got to watch these critical levels like a hawk. Step 1. The stock needs to break and hold above the $170 resistance level to confirm a genuine trend reversal. Step 2. On any pullbacks, it absolutely must hold above $155 for support. And Step 3. If we see a daily close drop back below $150, well, that strongly signals this entire 12% rally was just a head fake and the bears are back in the driver's seat.
Also, we absolutely cannot ignore the stock's beta, which sits at 2.03. Let me demystify that jargon real quick. Beta is essentially just a measure of a stock's volatility compared to the overall market, which always has a beta of exactly 1. Because Reddit's beta is over 2, it means it moves more than twice as violently as the benchmark. So sure, a 12% surge pre-market is incredibly exciting. But mathematically, this stock could just as easily reverse by 6% or more in a single volatile trading session if the overall market sentiment shifts.
Which brings us to Section 4, the final verdict. Let's pull the fundamental hype and the technical reality together.
Let's start by seeing where the pros stand. The average analyst rating right now is technically a moderate buy. But guys, there is a remarkably wide spread in their price targets. They are all over the map. You have JP Morgan taking a really cautious approach, recently cutting their target to $185 with a neutral rating. But then the overall consensus target sits higher, at roughly $220. And on the far bullish side, you've got Guggenheim maintaining a lofty $255 target. So even the experts are completely divided on exactly how to value this high-margin, high-volatility asset.
So the crucial point here is defining exactly what kind of market participant you are. If you are a long-term believer in Reddit's advertising growth and their future in AI data licensing, this S&P 500 inclusion is massive validation. It proves this is a high-quality, recognizable business with an incredibly strong fundamental floor. But if you're a short-term trader, you are strapping in for a highly volatile ride, battling against a bearish technical chart, all building up to a very specific expiration date, that actual index inclusion on August 18th. And I want to leave you with a final historical warning. The data actually shows that new S&P 500 additions often end up lagging the benchmark index by about 2% in the 3 months after they are actually included. What that implies is that the trade is usually front-loaded. The biggest, most explosive gains happen exactly where we are right now, between the announcement date and the inclusion date, as everyone tries to front-run the index funds. Once the funds mechanically buy their shares, that massive buying pressure exhausts, and the stock can easily pull back.
And that wraps up our analysis for today. You've seen the powerful mechanics of the S&P inclusion, you've seen those wildly impressive 91% margins, and you've seen the very real warning signs flashing on the bearish technical charts. So I'll leave you with this question. Knowing that massive index fund buying is coming, but history warns of a post-inclusion lag, are you buying the Reddit rally today, or are you patiently waiting for a technical pullback? Thank you so much for joining us for this explainer. Keep those charts open, and we'll catch you on the next one.